This is video 6 dealing with the example that combines IAS 8 with IFRS 9 and specifically share transactions in IFRS 9. We have already looked at what was done and what should have been done in 2009, and we looked at the correcting journal entry to fix the opening balance on 1 October 2009, which is the opening balance of the 2010 reporting period. It's the cumulative effect of the prior period errors on any year before the 2010 reporting period. So in our example, it was only 2009, but it could have been 2008, 7, 6, 5, further back, cumulatively all together. What would the effect be of all those years, of correcting the errors in all those years, together the effect on the opening balance of the 2010 reporting period? So now we go over to 2010 itself, because in this year the accounting system can be opened. We can fix this specific period. So this is what IAS 8 calls the period specific effect. So we need to write a correcting journal or correcting journals to fix this specific year. To do that, we need to know what was done, what should have been done, what is the difference, correct the difference. So what was done was given to you in the information in the question. They gave you the journal entries with the amounts. What is different in the solution, or what did the solution add? It just shows you how we got those amounts that were given to you in the information. So the first time that something happens is on 1 February 2010. What happens? New shares are acquired. These shares were recognized as inventories at the amount including brokerage fee. What should have been done? Well, with the new acquisition, the first thing that should be done is the investment should be recognized at what amount? Well, in terms of the rules of IFRS 9, it should be recognized at fair value. What about the brokerage? No, if you're on the category at fair value through profit or loss, that brokerage needs to be an expense. The bank amounts would be the same between what was done and what should have been done, because, as I said in a prior video, your bank amount is usually the same because you would do bank recons. You would very easily see if there was a mistake. It's usually not the place where the error is made. In this specific example, they told us very specifically that when there is an acquisition of shares, all the old shares that were there before this new acquisition, the previous shares that you had, will also be fair value adjustment. Is that always the case? Do we have to fair value adjust them right here? No, we don't. We don't have to do it, but we can. We can actually, in terms of IFRS 9, do a fair value adjustment every single day, because we are in the category at fair value. Your general ledger can be at fair value at the end of each day. You can make that happen. Is it necessary to do? No, because at year end, we will make sure that we do the fair value adjustment and that the shares on the statement of financial position are at the right amount. So this journal is not necessary, but that was their policy. That is how they did it. They did a fair value adjustment on all the shares they had when they got new shares at a new fair value. So in this example, there was a fair value adjustment on 1 February 2010. So what is the difference between what was done and what should have been done? It should never have been recognized as inventories. It should have been recognized as an investment. The transaction cost should have been recognized as an expense. And for this entity, because that's the way they do it, there should have been a fair value adjustment on your shares that you had prior to this acquisition. Then we go to the next date. It's 1 June 2010. What happens there? Shares are sold. So what was done? What was done first is that revenue was recognized because you sold inventories, and the inventories that were sold, the cost thereof was taken to cost of sales. What should have been done? First of all, we should have done a fair value adjustment, because in terms of IFRS 9, if you have a sale of shares that fall in the category at fair value, you need to do a fair value adjustment, then sell at fair value and show no profit or loss on sale. The second thing you need to do is de-recognize the shares. You have sold them, take them out. You no longer have them. Take them out at the fair value that you have just fair value adjusted to. The third thing, because there was brokerage fee in terms of the rules of IFRS 9, when you sell shares, you will have an expense if there are brokerage fees. We get to year end. What was done? Well, what was done is they calculated the net realizable value. Net means one amount minus another. They calculated net realizable value and they realized that there was another write-down of inventories. So credit inventories, debit cost of sales, because that is the line item that we include a write-down to NRV. What should have been done? We should have calculated the fair value of the shares at year end, and we should have done a fair value adjustment that can either be upwards or downwards. It goes through profit or loss. Now that we know what was done, what should have been done, we can identify the differences, and those differences we can correct by using a correcting journal entry. So let's just think about it. What do we need to change? Well, there should be no inventories. Take it out of inventories. The shares are not inventories. What should they be? They should be an investment in shares that at year end is recognized at fair value. What else should there not be? Well, there should not have been revenue. There should not have been cost of sales. What should there have been? There should have been transaction costs recognized as an expense, and any fair value adjustment, whether it's upwards or downwards, should have been recognized either as other income or other expenses. So take out the revenue, take out the cost of sales, bring in the other expenses, which are transaction costs, and bring in the other income, which are fair value adjustments. Now, in this specific 2010 correcting journal, you are allowed to show income statement line items. It does not need to be balances because you are fixing the specific period. The accounting system allowed you to open the system and post journals, so you can fix any item. It does not need to be a balance. You can fix income statement amount. Yes, they will pull through and change retained earnings, but that will happen automatically because the accounting system will do that for you when you post the journals to change specific line items. So it's different from the opening journal entry, the one on 1 October. There we could only use balances because we work with opening balances. This is the period specific journal, so you can change income statement and balance sheet amounts.